Good afternoon. This is Clark Neighbors with BIS Commodities with the market wrap-up for the week ending January 23rd. Coming off the January 12th crop report, the market has seemed to enter the typical winter doldrums as far as the grain's concerned. We'll talk about that in a second. But secondly, many of these markets are at or reaching some historical values that are worth noting. But going into the post-report, the main news conversation this week was more of a macro topic based on the European Union putting their quantitative easing program together, doing $60 billion worth of bonds on a monthly basis through 2016, something over €1 trillion. That, again, made the U.S. the safe haven, put strength in the U.S. dollar. The dollar reaching this week above 95 for the week. That's up about 3 points, and that is an 11-year high on the U.S. dollar index. I think that's very key looking forward to any of these commodities when the dollar has that much strength that is going to have some sort of suppression or limiting factors on commodities going forward. For the week, as I mentioned, winter doldrums. Corn was unchanged. Beans down 3 cents, or wheat down 3 cents, beans down about 20 cents. And we saw some major pressure in the livestock trade this week. Cattle down the limit today, both on the cattle and the feeder cattle, is down about $4 on the week. Hogs, for what it's worth, reaching to levels today going under $70, reaching the lowest level we've seen in 5 years. Keep in mind, 6 months ago the hog market was at all-time highs. And crude for the week, last but not least, even though it seemed to have found some support or some stabilization, is down $3.50 a barrel for the week. So some pretty dynamic areas. $1 highest level in 11 years. Lowest level on hogs in 5 years. I believe we're still at the lowest level in the energy sector in the last 4 to 5 years. So lots of interesting dynamics. Now this morning, because of the holiday, the export sales report came out with a very good number on corn, 86 million bushels. Beans were virtually zero. So we're in that time frame where we start from a capacity standpoint going away from bean exports and gearing up more to corn exports. Many of those exports in the corn were to our typical customers, South Korea, Taiwan, many of the Asian nations. We are right now the cheapest feed grain in the world, even with the high-priced dollar. Now, looking forward over the next 60 days, we have this window, and then once the South American crop or the Southern Hemisphere starts coming into play, it will become more expensive. There was a sale to South Korea today for June, basically 8 cargoes. We as in the U.S. got 1 or 2 of those cargoes. The balance went to the Black Sea region of the Ukraine because it's about $4 a ton cheaper. So you can see good corn sales this morning. The question is, how long do those last? A couple highlights coming off the January crop report. I think the key thing the market is trying to state since that report came out in regards to corn and soybeans is the fact the world's saying it doesn't need as many beans, or the market is saying to the world it doesn't need as many beans. To put that in perspective, the world bean carryout this upcoming year is expected to be 91 million metric ton. The biggest it's ever been before is 70 million metric ton. Another way to put that in perspective is 91 million metric ton for carryout. The Brazilian bean crop this year is expected to be right around 95 million metric tons. So the bottom line is the carryout supply of world soybeans, even with all this Chinese protein demand, is the Brazilian corn or bean crop. Weather in South America continues to look good. We have a little growing season to go, depending on what part of the continent you look at. But we're going to start becoming into a phase in, phase out standpoint as far as now talking about harvest export execution and so on. So, and the other thing, keep in mind on the soybeans, in the last 15 years, the world has doubled soybean production going back to 2000. So that's very impressive. The one thing to talk about in the corn coming out of the report, I think in general, we did see it, as probably as many of you know, we saw a slight decrease in yield. That had some impact. I think the market had that factored in over the last 60 days with the post-harvest firmness we saw in the corn market. But looking at the stocks report, the off-farm stocks, in essence the corn in commercial space, commercial elevators, was basically unchanged from a year ago, but the on-farm bushels are up over 700 million bushels. The question is, in these on-farm bushels, is when do they move? Currently, the U.S. farmer seems uninterested in moving any additional bushels at this time, based on price, based on cash flow needs, etc. When will that occur? That's the question mark. Because of that, over the next 30 days between now and the tail end of February, if that continues to occur and the market stays flat as it did this week, basis should have some firming or stable type levels over the next 30 days. Once you get March forward, that basis becomes a lot more blurry because of long-term demand and because we're narrowing in that time frame when we can see country movement. So producers may want to do some hard thinking here in the next week or so, and not only from a pricing standpoint, from a logistical standpoint. If we keep tying this country movement further and further back, that means there's more grain to go this summer. It may look like harvest type unloads into the processor or elevators from June forward this year, depending on when this product moves. So basis opportunities the next 30 days, might want to look at doing some pricing. If you feel you need some ownership of this corn, consider using some long calls. Call volatilities come way down because the market's flattened out. But you can spend probably less money on a call right now than the total cost of holding those bushels in a farm bin, and the calls aren't going to get moldy or start to smell. So consider that going forward. But again, basis looks good for the next 30 days, and after that point it gets rather blurry. Use those opportunities to manage your risk. Managing risk is going to be more important this year, and we've seen in several years the way it looks. This afternoon we also had a cattle on feed report come out. On feed came in at 101, slightly below the trade gas. Placements were down about 4% from the average trade gas at 92%, and marketing is pretty much in line at 95%. As I mentioned earlier, the livestock trade has had a pretty major hit. Hogs over the last 2 months, cattle over the last 30 days. It looks like a lot of that is just investment and outside money backing out of the market. Cattle open interest is down 70,000 contracts roughly in the last 45 days. That looks like money coming out of those commodities. Keep in mind the cattle and hog market, and more specifically the cattle market, was the best return of any commodity in 2014, so we might see some changes in regard to that. Going forward over the next week or two, no major crop reports coming out, and unless we see some big changes in weather in South America, there doesn't look to be anything that's much of a game changer, at least right in front of us. Feel free to give us a call if you have any questions here in Cedar Rapids. Phone number is 800-373-2525 or BISCommodities.com. Again, this has been Clark Neighbors with BIS Commodities, and have a great weekend.